Now, just as a reminder, please like, share, subscribe. Your support is appreciated. So now that we turn abroad, we are going to look at what's happening with the U.S. market and as it relates to internationally, and what are some of the adjustments that we're seeing in the global backdrop. So when we look at the U.S. crude and product exports, so you can see gasoline finally had that big drop that we were seeing, but it wasn't coming through yet. And here it is. It had a drop of 449,000 barrels a day. That's something that we think is going to hold now at these levels. We'll see a little bit of a pop back up. You have that overreaction to the downside as things shove off. But again, these are those back and forths that we continue to see. Then when we look at distillate had a small increase of 38,000 barrels a day. That's something, again, that's going to walk back a bit, but still stay within a fairly tight range at this point. Propane had an increase of 31,000 barrels a day. That's one that we think is going to remain strong. We continue even at elevated pricing of over $1. Really on its way to $1.05. We still see a lot of demand out there for the NGL side. That's where we're going to, a matter of when are we going to see the flip from more naphtha being run, just because there's a growing glut of naphtha versus NGLs. We're coming pretty close to that pivot point. We're just not there yet. On the other side, we had a small increase of 66,000 barrels a day of oil exports, getting us to about 3.717 million. This is one that we expect to see a fairly sizable drop off as we go through, not just, into the end of June, but well into July, just as we start to see some of that adjustment in general. So just when you think about where some of the shifts are, so West African crude flows to Asia will rise this month, increased shipments to China. So we're starting to see some of those adjustments. But then the absence of shipments from Qatar is pushing Mideast oil products flows to Europe to a 3-month low. U.S. refiners are sending surplus naphtha to Europe as other traditional buyers dry up. So that was some of that naphtha is being captured in this crude oil export. So that'll start to adjust a bit lower. West African oil exports to Asia are set to gain to 2 million barrels a day this month, the highest since March, as flows to China increase to the highest level. But then it's going to be partly offset by some of those declines into India and Indonesia that remain fairly sticky. As I said in the first segment, we're starting to see some of these declines and cuts in terms of some of the export-focused refiners. So when you think about some of these emerging markets in Asia, there are some refiners where almost 80% of throughput goes into the international market, and there's ones where about 90 to 95% stay domestic. We're starting to see some run cuts on the export side and it's not, as I said previously, it's not huge. We're not seeing 15% run cuts. It's more of cutting 3, 5, 7%, depending on where you are, what is the main export. Just because we continue to see this oversupply of refined products, which is going to reverberate. And as refined products remain elevated, guys are going to cut some of their runs, which is going to pull back on some of that oil demand. Again, seeing some of those shifts. So that's where we continue to see some of that adjustment from one to the other. And just in terms of how when you look at Latin America, the Delta variant, the other problems in general, you're starting to see some of that pivot where you continue to see those pressure points, which is just going to limit the amount of product that gets exported into the Americas, Latin America, and as well into Europe, as we do have additional flow coming in from Asia. And again, even though we didn't see those imports into Europe for June, we still had big increases in storage, which is why we saw some of that pivot into other markets. And now there's more coming back behind it for the month of July. So when we look at WTI Dubai spreads, you can see that we're just coming further and further negative, which just means that you would buy Dubai instead of the US, instead of WTI. Those are things that are just getting worse and worse when we look at just some of that demand for exports versus imports. This is where some of that flip is coming into play that we've been talking about. And then when we look at Brent premium to Dubai, you can see that the Brent premium continues to push higher. We're now back at the highs that we were at in 2019, which just means that you're going to buy Middle East versus Brent. There's some specific things that are happening within Europe in general, which is again keeping that fairly expensive versus other. So you're just not going to buy North Sea. You're not going to buy Europe the same way, or Brent in general, Fortes in terms of what makes it up, versus you're going to focus more on Middle East, West Africa, which is adjusting some of those crude flows. So not only are we getting an impact from the U.S., but it's also WTI also impacting Europe. These are some of those adjustments that we continue to see. So here's your drop in gasoline exports. We were expecting to come closer to the 5-year average. It went through that. Now we'll start to see this normalize. It'll come back up, and we think it's just going to essentially follow the 5-year average at this point as we go through the next few weeks. Then when we look at distillate, something similar, we were expecting it to just go sideways, and stay below the 5-year average, not make new seasonal lows, but again, just at the bottom level of that cloud in general. And there's really nothing to show that that's going to adjust, especially given where some of the new ultra low sulfur diesel is coming through. Then when we look at oil exports, you can see they still are remaining very strong. This is one that we expected to drop down. But drop down more than seasonal, come closer to that 3 million and then progress into kind of a steady 2.8. I know we keep saying it and it keeps not happening. And it's just a matter of timing, because we were saying the 3rd to 4th week of June, next week's number will be that 4th week. So it just means that it wasn't the 3rd week. It's going to be more the 4th week, and then continue into week 1 of July. And this is going to be something to watch, because we've already seen the shift on the tanker side, but we're not really seeing that in the numbers and in the filings, which is why we were saying that essentially the number that helps balance out the EIA is moved up to 10 million barrels of crude. And we think a lot of that has to do with some of the impacts or some of the adjustments that need to be made when we look at imports, exports. That's something that I think as it starts to clear and come through, you'll start to see that adjustment, which is why when we look at the 4-week average, we expect this to roll over now as we come into next week, and that'll accelerate over time. But when we look at propane, LPG in general, we're still at seasonally adjusted highs. We're going to remain at highs, whether it comes back towards the 5-year average, it's just going to be timing, but we're still going to stay well above the 5-year average, whether it's at the top of the cloud, making a new seasonally adjusted high, or well within, the cloud, but above that normal. So then when we look at GENSCAPE in Europe, you can see that there was a small decline of crude storage. Typically, this is where it starts to crest and come back down. We think that there's going to be one more increase before we start to see some of those steady moves lower. But again, this is always a bit noisy, and we're starting to see some talks of not a big cut, but just some adjustments with some runs in Europe. So we expect to see this come closer to that 7-year average or so. Now, as we go into OPEC, there are two things that we just wanted to touch on, because for those that have been following us, that have been reading, stuff that we put out, we never believed there was going to be an Iranian deal. We thought it was nice to talk about, let's see how each side feels, but we never thought there was going to be this huge breakthrough where an Iranian deal comes to fruition. When then in the Econ show, we showed why the Iranian economy is suffering and why they need one. But it wasn't that, the hardliners are not willing to make adjustments to the ballistic missile program, which is a big sticking point. And then with them falling out of the pact with the Nuclear Watch Agency through the UN, that has now expired. They haven't done anything to try to close that, which I think is kind of the last straw. But even when we look at OPEC production, so what is the spare capacity that still sits there? There's still that 8.4 million, and now the guesstimate going into the OPEC meeting is that we're going to see another increase in supply for August of 500,000 barrels. There's something where, well, what about the Delta variant? Is that you're starting to see that impact demand a bit? Or is that going to make them cautious? And I'm going to say it's going to make them cautious, but it just means that they can pull it back, because I think they're trying to play this a bit more aggressively now that you're seeing some of this inflationary pressures, which we'll talk about in a minute, looking at India. But this is where they're going to want to pull some of this back a bit. We're still at a very elevated level when we look at just OPEC production that is sitting on the sidelines that can come back and fill some of this void, which is again going to essentially put a cap on where prices can go in the near term. Now, when we look at what's happened so far with the loading schedules, you can see July is almost finished with their setup, and West Africa is still struggling to clear. That is a bigger problem when you start to see some of the movements from July into August. And we're starting to see that show up with Angola and Congo taking that higher for August, but that some of that is that kickover from July that wasn't sold. Russia we're starting to see some adjustments in terms of where flows are. Libya, we're going to get back above 1 million for July, but we're seeing commentary that, things are really tight on the physical market. And if you look at spreads, they are, but for some reason where people are aggressively playing some of these future spreads, but when we start looking at the spot and the forward physical market, it's a little bit different. So Trafigura sold Urals at lower prices than previous trade, while Libya raised crude OSPs for July to an 11-month high. But let's break that down. So Trafigura sold 100,000 tons at $2 minus Brent. Last trade was at $1.70 minus Brent. Then when you look at Libya raised their OSP to minus $1.35 from dated Brent, which was at a minus $1.95. OSP for dated July was minus 80 cents, and it was $1.45 in June. Now, it's also important to appreciate that they typically increase OSPs in peak demand season, which is that July, August. Now, why is it peak demand? Well, one, you have more local consumption for electrical generation for AC, as we see from the Middle East. So some of this increase that we're going to see is also going to be locally consumed. And then when it's obviously done, it can get slated for the export market. But that's where we normally see OSPs get tighter at this point in time. And on our Friday show, when we talk about the Frac spread show, the Frac spread count, we're going to look at what is the seasonality kind of look in terms of where should it be, where has it been historically, and where is it going to be going forward. So then when we look at some of the other cargoes that have sold, Surgut sold 3 cargoes of Urals to Trafigura for the end of July. That was at $1.40, fairly in line with where it was previously. And then when we look at some of the other backdrops, when we look at Angola, plans to increase its oil exports in August, while Congo plans to add a shipment of one of their grade. And then the official selling price of Oman crude was set at $71.66 a barrel for August sales. According to the average of the Dubai Mercantile Exchange, the OSP was $5.26, higher than the $66.40 for July. So again, seeing some of that movement up, but it's moving up, but WTI and Brent moved higher, so that's why you're still seeing some of that movement out of Dubai and the Middle East versus some of the others. So it all depends on where you are, because Russia, or I should say ESPO, Surgut still remains fairly strong. Brent is still seeing a little bit of that paper versus physical trade, where West Africa still remains fairly weak. We started to see a little bit of a normalization, as we talked about in the first segment. Some additional flows are heading to China, a little bit less to India and Indonesia. Again, that shift of cases, where some of the adjustments are. And because China is going to import a little bit less semi-refined goods, I should say semi-refined products, that's going to shift some of the flow. So that's where we're starting to see some of those talks of additional run cuts in general. So then when we look at some of the builds that we've seen over the last few weeks, we've continued to see some, Fujairah go back and forth with some of the builds in general, but we actually got a sizable one, and it was all driven by light distillate, where there was a total 23.064 million. Total stocks were at 437,000 barrels in general, which is 1.9% week on week. The stock of light distillate was up 1.833 million which is up 33.8% on the week, which is a 13-week high for distillate, which has been in a decline since March, but it's been a decline. We've had some builds and some drop-offs. This is taking us back above that high level. And when we look at it, the Middle East market, again, continues to struggle because there's production disruptions out of the Abu Dhabi National Oil Company's Ruwais refiner, and then the Reliance Industries Jamnagar refiner, which is, again, taking some product out of the market, but it's also taking some of the crude demand out of the market, which is putting a bit more into the export market. But this is something that we should start to see adjust a bit. But again, we're starting to see some demand come back in for light distillates, but then it's slowing in others. So that's where we continue to see light distillates, not so much going much higher, but just, again, kind of going sideways at this point. Then when we look at middle distillate, fell by 313,000 barrels to 3.943 million, down 7.4% after rising 263,000 the previous week. And the sentiment for gas oil east of Suez has gotten a bit better with India coming back a bit. But steady demand centers out of Australia have softened. As you see, economic growth prospects from Asia have gotten called into question a bit, and not to say that we're not going to see some growth. It's just how quickly does it come back? How much of an impact does the Delta variant have on this region? So middle distillate is where we think there's going to be some of that is going to refill, and we're going to get some builds over the next week or two when you look at middle distillate. But then when we turn to heavy resid, there was a draw of 1.083 million, down 8.4% on the week. And the draw came just because the bunker fuel demand did pick up. That's where we did see, we're seeing an increase in shipping, which again, it's just going to be a matter of timing. So that's something that we think is not going to see any real builds at this point, just because there is this big pickup in shipping as we go through July and August. And so it's just going to be a matter of, when do the refiners come back? Because when you look at the refiners on the middle distillate side, they use middle distillate diesel gas oil for power gen. And as that power gen remains elevated, you'll see some of this remain depressed. You'll start to see some of that come back as the refiners start to normalize a bit. But again, these are things to watch. But again, the light distillate side on the gasoline front is the one that we remain a bit concerned on, just because we did get those big increases in exports. There's a bit more slated, and we're going to start to see that move through again. Now, crude oil in the water was up, and you're starting to get closer to the 5-year average. This is going to continue to trend higher. And this is where we talked about the shift from crude oil in storage to crude oil in motion or transit. So crude oil on the water actually increased, with crude oil in transit now back at the 5-year average, which is what we were saying based on what we were seeing, that we saw more cargoes getting released, more cargoes being moved into the market, which again has put us back on that 5-year trajectory. But then when we look at crude oil and floating storage, that dropped to compensate where you've seen a steady increase of storage coming from a boat to onshore. And then you've actually had cargoes released from storage, floating storage, to go back into transit. So you can see here, when you look at even 2020, when you look at 2016, you have that kind of steady move down. That's where we think you're going to continue to see some of that move, and then the rate of change is going to slow, and you're going to see it track, I think, closer to where 2016 is, and we're going to have kind of this gradual move as these adjustments are made in terms of where are things going, where are things flowing, and how is that going to adjust over the coming few weeks. And it's really going to be driven based on, okay, well, let's look at some of the European products. So here, when we look at gas oil, we're back to the 13-year average. Gas oil had another increase in storage by 84 tons. Then when you look at the total, we're at almost 2.5 million. Gasoline had a small draw of the 41. That is now going to start to slow as exports slow, and you're going to start to actually see that adjust in general. And that's when you start to look at some of the adjustments where what is coming into the region. And when we talked previously Like VLCC Sur, laden with clean product, has changed its signal destination from northwestern Europe to West Africa. That was what we were talking about, where there was a lot that was supposed to come in June, and it all kind of got siphoned off, and now there's still more set to come in July. But you can see, even without seeing this big increase in June imports from Asia, we're still seeing this pretty steady movement, because we are seeing a pretty steady flow coming from the Middle East, and then some of that doesn't go into Europe is coming into the U.S. markets. Now on the gasoline side, we're getting much closer to that 13-year average. You can see that the draws have started to slow. Here they're just gonna go sideways at this point. They're really gonna flatline and flatten off, just because there are some imports coming through. There's the exports have started to die down, and that's where you're gonna start to see some of those adjustments. Then on the fuel oil side, picked right back up. We're right at the back to the seasonally adjusted high. Fuel oil in general went up about 20,000 tons to about 1.5 million. This is something that we think you're going to start to see some recracking. You're going to start to see this being utilized, and this is where we think this is going to go a bit more sideways. Now, when you look at Singapore had a draw of 1.2 million. There was a draw in resid. There was a small build in the middle distillate, and a small draw in light distillate. But when you look at the average in general, what we were saying is that we were just going to go sideways. Like we're not going to take out the low that we had in the end of May, and we're not going to take out the high that we had at the beginning of May. We're just going to go sideways at this point, because there's going to be enough exports to keep us elevated, enough sporadic demand to keep things moving out. So again, we're just going to go at this sideways pattern. But when we were talking about middle distillate, this is what we were saying. We're going to get this big spike off the bottom and then just go flatline. And that's where we continue to see these different competition back and forth, where there's not going to be too much movement one way or the other, just because we're not seeing that demand driver that we've been hoping to see, as you also have some of the crack spreads coming under pressure. Now, light distillate, you typically see some pretty steady draws. Instead, we're still at a very elevated level, still making a higher low, and higher low, and that's where we continue to see this now essentially go flat, where there's a decent amount of new exports coming out. That's going to start to slow, and that's where we continue to look at how is this going to adjust, how are refiners going to react, and that's where you're going to see some of that reduction in refined throughput, but you're also going to see that reduction in demand, which is going to keep us essentially fixed at this rate. Now, the Brent time spread August-September had a big drop-off to 43. This is a mixture of two things. One, you had a little bit of softness in the next two monthly time spreads. And this one is expiring, so August expires this week. So when you shift over into September, October, you're actually seeing it's held in better. It's at about 72. It's come off about 5 cents, but it's still holding in better. But again, you're starting to see some of that softness in some of these time spreads. Then when you look at Brent WTI, we've kind of flatlined here, and this is that competition where things have gotten expensive. Do I need to get some of these time spreads on December, or does it make sense to look at West Africa? Does it make sense to look at Middle East? And that's where you're starting to see some of this flat line and level off a bit. And it's also driven because these refiners are not making money. So here you can see Singapore firmly negative and getting worse. And this is just some of the quotes that we have. So some of Asia's biggest export-focused oil refiners are looking at cutting processing rates as COVID-19 crimps demand in parts of the region, and as China and India flood the market with excess fuel. That is going to slow down out of China for July, but remain elevated out of India for July. So you're going to get a little bit of this friction point between China getting a little bit better, India staying fairly saturating, which is going to adjust. And how is that going to adjust? Well, exacerbating the demand for the merchant refiners in South Korea, Taiwan, and Singapore, the ones that are more export oriented, is the surge in crude price, which have outpaced gains in fuels. Because when you look at where Brent prices are and where distillate prices are, distillate is essentially flatlined due to the elevated level of product out there that's just floating, competing, while Brent has continued to go up. So as you have essentially the differentials getting worse for crude, for the refiner, differentials not getting any better for the refiner for the product, it just doesn't make sense to run. So then when you profit margins from making diesel, the main oil product exported across Asia, has eased since mid-May, while overall fuel stockpiles in Singapore are comfortably above the 5-year average. South Korea's GS Galtex Corp is considering a slight run cut. Rates in August, said people familiar with the matter. And then Taiwan, Formosa may reduce rates if margins drop further. Demand is still struggling with the drag of COVID, and the export-oriented refiners will be hit hardest. Coming from Victor Schum of the IHS market, there's really no reason to increase crude runs. You typically start to see an increase, not going to get it. Instead, you're going to get a little bit of a decrease, which again is going to hurt Asian crude demand that we continue to see and talk about. And this is just looking at one of their key cracks. You can see it's still holding at that seasonally adjusted low. We don't see that getting any better. If anything, we actually see it getting worse, which is why we think it's going to roll out of this lower this cloud. When you look at, why? Well, let's look at India. So India's, the fuel price in India are at record levels, even though Brent is well below its peak. So when you look at Delhi gasoline prices, Brent futures, you can see that gasoline prices are at a record level, and most of it is driven by taxes, because when we look at gasoline in 2014 and gasoline in 2021, you can see how the federal tax has more than doubled. Same with diesel in between 2014 and 2021. So a lot of these increases have come from federal tax, state taxes, with the base price, actually being much lower. So this is where you're starting to see some pressure now, as India is starting to say, hey, our budget deficit is growing. Maybe we're gonna have to pull back. But the problem is, a lot of their, what's the best way to put it? So a lot of their deficit factors in flow from these tax receipts. So if these tax receipts go down, then that means that their budget deficit's going to get worse. So they're kind of stuck in the middle of, what do they do going forward based on some of these underlying pressure points? Then when we look at Northwest Europe, Ural margins have essentially flatlined. You can see that there's some pressure to the downside. It's still just barely positive, but now you're starting to see Libya increase OSPs. What does it actually cross at? Urals are starting to get cheaper, which again is trying to kind of stay competitive to keep some of these Urals moving, because $2 off a dated Brent is one of the lower prices we've seen over the last 3 months. It's not at the lowest, which was 240 to 290 versus dated Brent, but again, it's moving in the wrong direction. Then when you look at Mediterranean Urals, you can see that things are now firmly negative and starting to flatline, but getting a bit worse. And this is, again, they're trying to mitigate, which is why the Urals are getting a little bit cheaper, try to offset that. Now, here's it's a little bit of an old number where crude super tankers are at 79. This has actually recovered a bit. We're closer to about 85 now, closer to about 82, 83, maybe an 85, depending on what comes on when this gets recalculated on Friday. But we'll provide that adjustment on Friday for the Frac Spread Show. And then we look at teapots. They're running at about 74.5%, which is at the high level. This is one where they're trying to work through some of the product. They're trying to capture whatever they can. This is where we think there's going to actually be a fairly large step down in teapot run rates, which is just going to be driven based on the drop in import quotas and then the drop in export quotas as well, which again is going to put some pressure on that market. Now, when we look at Asian floating storage, and we're going to talk about that in more detail at the end after we go through some of the storage side. So here you can see Asian floating storage, continues to wind down. It's just the pace of declines have slowed. Again, we continue to think this is going to be kind of that steady, a little bit of a flat line, some increases, because again, we saw product go from storage to mobility. So you saw it go from floating storage back into in transit, and then as it shows up, it'll come back, and we'll start to see this level off. But when you look at those normal time periods, or normal, relatively speaking, 17, 16, you normally see these drops here. This is what we're going to want to watch to see how quickly does this drop down. North Sea continues to increase. We think this is going to continue to see some steady step ups, still below the 5-year average, but again, some of these counter seasonal builds in floating storage, just given pricing. Like pricing dictates that you're not going to take as much from the North Sea in Europe and the US as you would from some of the other regions, specifically West Africa, which is where we saw a small increase in movements, so a small decrease in floating storage. But we're starting to see some cargoes added, some getting shifted over. So we think floating storage will remain at an elevated level against the 5-year average. Then when we look at Middle East, against the 2017, 2016 fight for market share, we're still at record at fairly elevated highs. I shouldn't say record, but at fairly elevated highs, given where we haven't seen much drop. Now, that drop down that we've seen is that the fact that Dubai and the Middle Eastern cargo is more competitive versus Brent versus WTI, and even in some cases, some West African grades, which has helped pull some of this excess out of the Middle East. But we do have an OPEC meeting, and the OPEC meeting is going to be the expectation of that 500,000 barrel addition. We'll cover that more in the Friday show, as obviously they're going to come out with their numbers for Thursday. Now, Europe, we're continuing to see some of these builds. Floating storage, we think, is going to continue to work its way up and still fall outside the 5-year average, but again, back further within that cloud as the pipeline is back in operation and we start to see some of those loadings. Now, when we talk about China for a minute in terms of some of the destocking, China's crude stockpiles are at the lowest level this year, just lower imports. So we've seen some elevated runs, lower imports, which has kept some of that crude, again, offshore and into other markets, which is why we see some of that disconnect between where's Angola selling crude, where's Congo selling crude. It's because China's really not buying as much, opting to try to pull out of storage. And it's a smaller number. It's about 600,000 barrels a day out of storage, but starting to work through some of that excess because they're still over 100 million barrels above where they were pre-COVID. So there's still a lot of work, but 500,000 barrels a day to try to work off 100 million barrels of excess is going to take a fairly sizable amount of time. But then when we look at Shandong numbers, you can see that they've essentially flatlined. This will come down again. But throughout all of China, inventory shrank that 6.28 million barrels to 974 million. But that's off of a peak of about 1.012 million. So about let's just call it a billion barrels. So we went from 1 billion barrels to 974 million. So again, we're not seeing a huge drop down, especially given that they're still, again, 974 million is where they sit. Prior to COVID, they were just at about 860. So 110 million barrels to get back to where they were pre-COVID. So, and that because we always hear OECD versus non-OECD. So when we look at fuel, China's Shandong fuel oil stockpiles, they're back at those 2021 highs. This is one where we're going to see some of these exports accelerate, putting more pressure on some of the fringe refiners, which again speaks to why we think some of those runs are going to have to get cut. China exports of gasoline, seasonally adjusted all-time high. This is, instead of seeing the normal seasonal drop, you've had this actually accelerate. We're going to talk about China a bit more because we still see a fairly slow mobility. It's still about 10% off of normal. And we still aren't seeing people go to Macau and some of the other key travel areas, but we'll talk about that more in the economy show. And China's independent oil refiners in Shandong province are likely to cut overall run rates by 300,000 barrels a day in the second half after Beijing reduced crude import quotas. According to FGE, the reduction in the second batch of allocations came after the recent clampdown on illegal quotas. China's state-owned refiners are steering away from the export market and keeping more gasoline in the country. So that's where we're seeing that, as we said previously, we expect this exports to drop and come closer to seasonal norms. But again, this is kind of expected within the market. Gasoline exports will drop to a 13-month low of 160,000 barrels a day in June, according to some preliminary estimates. So we're going to see this come back within this kind of normal level, but it'll be interesting to see what does what the teapot region tried to do, as we saw a diesel drop back within kind of this comfortable level. But remember, there's been that adjustment of some of the blending capacity of what refiners can blend. So there was this, let's hold some of this diesel back, not export it because we're not going to be able to blend, try to sell it internally. So again, there's a lot of shifts going on within the market, which we'll provide more color on Friday when we have more information from OPEC. I know we covered a lot. Any questions you have, please let us know. We're always happy for the back and forth. Please, again, like, share, subscribe, especially subscribe. It helps us a lot. I was on vacation. So I haven't had a chance to get back to some of your comments. I will try to do that, either later today or tomorrow. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.